Okay, we'll get started now, just so that we can squeeze as much of this in, squeeze as much information in as we can in the next hour. So thank you very much for joining today's webinar. We'll just do a quick introduction. I'll give you the running order as we'll do a quick introduction from myself and Andy. I will then cover a bit on the UAE, structuring the UAE and why you should consider the UAE as a place to migrate your business and your life. And then Andy will look at the tax benefits to that as well. So first of all, as I said, thanks for joining. I'm Paul Bryson. I'm the Managing Director at VirtuZone. We are currently the largest corporate service provider in the Middle East. We're establishing around 500 companies a month, helping people from across the world into this market, process their visas, and set up their businesses. I've been structuring and restructuring companies in Dubai for the last 12 years. And prior to working to VirtuZone, I've been here for the last 6.5 years. Before that, I was MD of a law firm here based in Dubai, where we purely focused on, again, corporate structuring and market entry. Andy, perhaps you want to give us a bit of an overview on an intro on yourself?
Yeah, sure, Paul. Good afternoon, everybody who's on the webinar. I'm Andy Woods. I'm a tax barrister and tax advisor, primarily advise on UK tax matters, but I do live out here in the UAE these days. So the interaction of the two is something that I deal with on a regular basis.
Okay, thank you very much, Andy. So look, we'll kick on. Today's webinar is recorded. We'll be able to share it with you after if you miss anything or if you were late in joining. We'll also share the slides after it. And if you've got any questions or anything that perhaps we don't cover during the presentation, we'll have a space for a Q&A at the end. And equally, we will share our contact details if you want to reach out and have any other questions answered. So thanks very much for joining. So first of all, if we take a look at the UAE as a whole, a lot of people coming from the UK, a lot of people don't know the UAE, haven't heard of the UAE. They think of Dubai often as the country, and they know they've heard of Abu Dhabi, but don't necessarily know the differences. So just a quick overview on that. The UAE, the United Arab Emirates, is the name of the country. It's a federation made up of 7 emirates, a lot like the states make up the United States of America. They have their own autonomous governments within the states, but there is a federal law as well, which governs the entire land. The UAE has the second largest economy in the Middle East, second only behind Saudi Arabia, which is one of the largest economies in the world. And right now there's around 200 flights per week between the UAE and the UK. And that's between Emirates, BA, Etihad, Qatar Airways. So you'll find there's it's very, very well connected. It's easy, depending on where you're based in the UK, it's very easy to get here and to get back. Currently number 1 in FDI inflow in the Middle East. So more foreign investment coming into the UAE than any other country inside the GCC and the Middle East. And when it comes to doing business, the UAE ranks 16th in the World Bank's Index of Ease of Doing Business. That was last published 2 years ago. And when it was published, the leadership of the UAE had a goal, particularly of Dubai, had a goal where they would like to become number 1 for the next time out. Usually when the leadership set themselves a goal, they tend to achieve it next time round. So again, that's something we're waiting for that to come out again and see how far we've moved up there. What you'll find is when you drive around Dubai, you'll notice easily that 80% of Fortune 500 companies have a presence here. You'll see Microsoft's, Google's, LinkedIn's, Sony, Hitachi. You'll see their logos sticking out of buildings all over the city. It's common to see them and find them here. And the geographical location of the country is fantastic. It's really convenient because it does connect east and west, and it sits in the middle of a time zone where you can speak to your office in Sydney and your office in Toronto on the same day. A 3 to 4 hour time difference depending on the season between the UK. So very easy to do business here between the UK. And within 2/3 of the world's population is around a 7 or 8 hour flight, which I think is a fantastic statistic. So you can serve we can serve the wider region easily from Dubai. And what we tend to find is companies, when they come here and they want to do business in Kuwait, Qatar, Bahrain, Oman, Saudi Arabia, even Iraq, Iran, and Afghanistan, tends to be harder to attract people to go and live in these countries and work there. But it tends to be easier to attract them to live in Dubai or Abu Dhabi, and then travel and commute and do business inside the wider region, and then fly back and keep their family in Dubai. Again, there are key advantages you want to look at. For Dubai, a healthcare system is completely state-of-the-art, second to none. It's 100% private, so you do need a health insurance policy, but they're far more affordable and far more common here than they would be in the UK. And if you have an employer, they will provide you with generally a fantastic health insurance policy, and you will have access to world-class clinics like Cleveland Clinic, like Mayo Clinic, like King's College Hospital, London. You'll find them all here. The lifestyle is excellent. You will live a very good expat lifestyle. It's a diverse city with over 200 nationalities living in the city. Being British, we love talking about the weather. The weather here is fantastic. You're pretty much guaranteed sunshine. Although if you've been keeping up with the news, you will have noticed in Dubai, there has been a bit of rain and flooding in the last month, and probably another 2 days of rain coming in the next 2 weeks. So it's not too bad. And then once we get past that, it will be dry throughout the entire summer again until the end of the year. Education system is excellent. People do tend to relocate here purely for education up to university level. When it comes to university, kids tend to leave the UAE as a small country. Everybody wants to go to Europe or the US to study once it comes to university, but up until high school level, you'll struggle to beat the UAE for options and for quality. And it is not only a very culturally diverse country, but one of the safest countries in the world. Dubai and Abu Dhabi tend to rank often, both of them in the top 5, depending on who ranks them, as the safest cities in the world, and the safest cities in the world for women to be alone as well. So it is all round, a fantastic place to be from a lifestyle standpoint. When it comes to a business standpoint, you'll find, when I talk about how easy it is to do business, you'll find a lot of support here, whether that be through networking groups. They're very easy to find. And I'm sure Andy can testify to that later as well, but for when he moved here, and I know from myself. So you'll find here the British Business Group, now renamed the British Chamber of Commerce in Dubai. Like-minded British professionals, all here to work hard and really help each other. You'll find a lot of consular support in the UK Embassy and specific trade groups, again, through the Embassy. You'll find a lot of Facebook groups dedicated to business, purely for expats, British expats, European expats, and sector specific. So depending on the sector that you're in, you'll find a lot of support there. So as there's business here. It's just coming here, making the effort to find it. Once you're here, you'll see the floodgates open a little bit. And while we have time and while we're on it, I'll give you a quick overview on the different types of jurisdictions. So although the UAE is a very small country, we could set up a company in the UK for between £50 and £200, whether we use a lawyer or do it ourselves on Companies House. There's one jurisdiction, whereas inside the UAE, there's over 65 jurisdictions between the 7 Emirates. So it's quite a lot of choice. And between these jurisdictions, they all have their own rules, regulations, regulatory body. They'll all tell you that one is better than the other, or they're better than the other ones, and that you can sell your product or provide your service within their specific location. But they all have their own benefits and they all have their own drawbacks. And that's why someone like us would tend to point that out to you, because it can be a bit of a maze when you come here. The three companies are generally broken down into 3 key jurisdictions. There'll be a free zone jurisdiction, a mainland jurisdiction, and an offshore jurisdiction. And you might sometimes hear mainland called onshore and free zone called midshore, but they're interchangeable terms. But it's common that you'd find a free zone, a mainland, or an offshore company. An offshore company is a bit like a typical international business company or an IBC that you would find in the British Virgin Islands or the Cayman Islands or the Isle of Man, where they're purely used for holding assets, or created for a special purpose here in country or a special project. They don't allow you to do business in the country, to invoice in the country, to take an office or to have a visa. They're purely used generally for asset protection. The two operational types of entity would either be in a specific free zone or based in the mainland of the UAE. What's the difference between them? Well, a free zone is an area which is deemed non-mainland, and it's a geographical, it has a perimeter. Sometimes the perimeter is visible, but in most cases it is not. So you don't know when you're entering into a free zone and out of a free zone. You can be in the mainland in one street, and then when you cross the road, you're in a free zone. Equally, some buildings have dual purpose use. It might be on one floor as a mainland floor, and the other could be in a free zone. So, you need to really know where you are and how you can trade. But again, that's why people like myself and Andy are here. We can simplify that process for you. Free zones are special economic jurisdictions inside the UAE. They were created to really help speed up companies' law. So around about the mid-80s, I think 1985, Jebel Ali Free Zone was created as the first economic free zone where foreigners could then own 100% of the business. Historically, as a non-UAE national, you could only own up to 49% of a business in the mainland, and then you required a local partner to hold shares on your behalf. So in order to circumvent that, and as a means to quickly attract foreign investment into the country, economic free zones were set up. Initially, they were themed around sectors like shipping, logistics, healthcare, finance, IT. Now, we tend to find that the free zones are mostly generalist free zones and not sector specific. Again, you can own the company 100% in a free zone, but you're restricted with two things. You can only rent real estate space inside that free zone, and you can only do business inside the free zone where you're based, which is a real drawback if you're selling a physical good as opposed to providing a service, which we can touch on later. The other option, which is very common, probably the most common, would be in the mainland. So you would set up a mainland company in Dubai or Abu Dhabi. 3 types of license that you can get there as a commercial, a professional, and an industrial license. And again, they allow you to, there's 3,500 economic activities that you can choose within that, predefined, and they'll go on your license. Mainland companies allow you to rent real estate anywhere in Dubai that is non-free zone, which is most of the place. And then it also allows you to do business inside Dubai, anywhere you want, and in the rest of the world. Free zone companies also allow you to do business in the rest of the world. If, however, you're coming from the UK and you want to do business with local companies or government entities, you really must consider a mainland license, because to get on procurement lists for people like Emirates, Nakheel, Emaar, Damac, then you really want to have a mainland license to get on the procurement list and be successful. And if you're doing with government entities like DEWA or ADNOC, you might need to look at your license, perhaps being in Abu Dhabi, or if you're dealing with DEWA, then in Dubai. Okay, so that's the three things that you need to know about free zone, mainland, and offshore. I won't go into too much detail on them. What I will do at this point is I'll hand over to Andy, who will give us a real specific and in-depth case study from the UK and how someone like yourselves can come from the UK to the UAE and optimize your tax position. So Andy, you can take it from here.
Okay, thanks, Paul. Well, very interesting stuff there. When I thought about how we might consider the tax aspects of moving from the UK to the UAE, or from, I guess, to an extent from anywhere to the UAE, I thought there were perhaps 2 ways we could do this to make it a bit more interesting. The first was to look at it via a case study. The second would be via means of dance, and Paul was keen to show us his Cayley skills, but fortunately, I think for everybody, I went for the first option, which was to look at a case study. So let's introduce the guy who will be man of the hour, which is Jimmy. Jimmy is known as Jimmy the Glass, and that's not because he's some kind of 1960s East End gangster, but the fact that he's built a very successful double glazing business in the UK. Secondly, his real name isn't Jimmy, it's Dimitri, and he's originally from Cyprus. He's lived in the UK for around 9 years or so. He's certainly non-domiciled from a UK tax point of view. And between you and me, he's rather enjoying using the remittance basis. He says basically, if it's good enough for Mrs. Sunak, it's good enough for him as well. So his business has been so successful over recent years that several third parties have come along and they're interested in essentially making a move for his business. And there's an offer of £10 million on the table. And that will pretty much all be profit, all be gain for Jimmy. So not too shabby at all, really. Further, Jimmy, again, with his Mediterranean roots, is a bit bored of the cold weather in the UK. Also, he's heard on the grapevine that Chancellor Jeremy Hunt is going to take away his beloved remittance basis as well. Fortunately for Jimmy, he's spent a number of years in quite a bit of time, sorry, over the years in the UAE and in Dubai. He's got a bit of a side hustle going on, selling Cypriot stone into sort of luxury property developments. So he's a man of many talents, let's face it. So he's thinking maybe in a couple of years' time, potentially from the 6th of April 2025, he's thinking that he might want to go and live in the UAE. What might he do there? So it says on the slide, he's got a few opportunities in terms of work, because Jimmy, Jimmy being Jimmy, isn't going to retire. He needs to do something productive. So he's got a couple of options there. His brother runs a company formations business in the UAE, obviously a competitor to Virtuzone. And Jimmy will be a very good business developer. So you need to watch out, Paul, here. So the second option is he could set up a business in the UAE, importing high-end kitchen worktops using that sought-after Cypriot stone I spoke about. Or alternatively, Jimmy's got an interest in properties as well, so he could buy and potentially flip off-plan properties as a UAE sort of landlord or property developer. So decisions. He's got to think about what he might want to do. But let's pause for a minute there. So yeah, that's the right slide, Paul. Let's pause there. What is his current tax treatment? So I've said that he's a UK resident, he's non-domiciled for tax purposes, and he is using the remittance basis. Now, what does that gobbledygook mean? Well, it means that he's, first of all, on UK income and gains will be taxable like anybody else as they arise. On foreign income and gains, he's taxable on the remittance basis, which means he pays tax if he brings it to the UK or otherwise enjoys those funds in the UK. And that's why, a lot of people see it as a bit of a bit of a privilege and a bit of a, people call it a loophole. It's obviously not a loophole because there's an awful lot of legislation there setting out the remittance basis, but certainly it's brought a lot of controversy over the years. But of course, not everybody's non-domiciled. So what if Jimmy, rather than being Jimmy from Cyprus, was Jimmy from Cirencester? Then the tax position is very different in that he will pay tax essentially on worldwide income and gains. So there are changes afoot, though, aren't there? Even Jimmy's heard about these, and Jimmy doesn't long since start turning off the UK news. But there are some important changes in this area mooted. They formed part of quite a surprise part of Jeremy Hunt's budget, a few weeks ago? Was it March the 6th, something like that? I can't quite remember. Interestingly, despite the draft legislation being published last week, at the end of last week, there was no neither hide nor hair of these changes. So somebody's going to frantically have to draft some legislation in due course, but it does just indicate that it perhaps was a bit of a last minute decision. So enough of that waffle. What are those changes? Well, the first and probably most important thing to take away is that the non-domicile and remittance basis will be removed from the 6th of April 2025. It won't be taken away and nothing will stand in its place. There is a new regime to keep attracting the wealthy internationally mobile individual, and that will be a regime which is based on residence rather than domicile. Residence is a much more precise measure to determine somebody's tax. Domicile is a very, very complex area of general international law. So residence, which we have a statutory residence test we'll come to in a minute, should be able to give us a clear-cut result if we feed in the right facts. So the new regime from the 6th of April, the detail is a little limited at the moment because the legislation isn't there. But what it will mean is that a new arrival into the UK will have an exemption from paying tax on foreign income and gains for 4 years. The first 4 years, they are resident for tax purposes in the UK. Doesn't matter if you bring the foreign income and gains into the UK, as long as they arose during that window, you're free to spend them in the UK. And that makes much more sense from an economic policy, allowing people to bring the money in and spend it in the local economy rather than making them keep it offshore in some kind of financial purgatory, which is the case with the remittance basis at the moment. So the key point is who is a new arrival or a new arriver. That will be somebody who comes to the UK, takes up residence, but hasn't been resident in the UK in any of the previous 10 years. So, as I say, it's firmly based on the residence position of the individual and not on the domicile position. In terms of inheritance tax, whether you're the extent of your exposure to UK inheritance tax is also primarily actually at the moment determined by your domicile status. That is going to change as well, but I'll come to that towards the end. But those expats who have perhaps been out of the UK for a long time and may be thinking about going back to the UK, exploring perhaps whether this new regime applies on your return to the UK. It is an interesting one. So I think Paul mentioned he'd been in the UAE for 12 years. So, for example, if he was to go back to the UK and become resident from the 6th of April 2025 onwards, potentially he could benefit from that regime, and that any foreign income and gains he wouldn't be taxable on for 4 years in the UK and could bring them into the UK to his heart's content. Paul, I'll send you an invoice for that advice shortly.
I've just made a note of that already.
Yeah, I'm done. So we think we can move on, I think.
Yeah. So I think what we looked at then was you were saying Jimmy had contemplated a move to the UAE specifically. And there's a few things that he has to do when he's considering that, particularly from a business standpoint. First thing is, again, he needs to, before he does any of this, is establish where am I going to be based? And first thing there is, where's the audience for Jimmy's product or his service? If the audience is based in an emirate, he should be in that specific emirate. For example, if he was in the oil and gas industry, he should be based in Abu Dhabi, likely. If he's going to be doing business with ADNOC or the Supreme Petroleum Council and needs approval there, then he should be based there. If he's going to be based in a specific free zone or in the mainland, so once we've established that, he will need to prepare some documentation, and It could be very simple. He could be owning a business here in his personal capacity, where he holds 100% of the shares, and that's very easy to set up and straightforward. There's not too much documentation required, but perhaps if he was creating a branch of his UK company or a subsidiary of that, which Andy might advise against or for, in a specific for a specific reason, then he would need documentation in the UK notarized and attested there through the Foreign Office to the UE embassy there, and then they'd have to come into this country and be stamped here by the Ministry of Foreign Affairs and translated to Arabic. So it can be a bit of a laborious process, and costly as well. Again, it's something that we can help you with. Then you obtain your business license and get your visa processed. The visa will then let you open a personal and corporate bank account. Then you need to start considering what you need to do tax-wise, and then that's when you're going to have to register for corporate tax inside the UAE. And then again, that's you. You're free to trade. You can do as much business as you want. So there's no issues there. It's quite easy and straightforward. Perhaps Andy will want to tell us a bit about Jimmy's UK tax residence position, and maybe whether Jimmy should consider owning a business here in a personal capacity or a branch for a UK company or a subsidiary.
Okay, yeah, thanks, Paul. And I think it's important to note, and I know I'm a tax professional, and and Paul's into sort of an expert on where to set up your company, where and the related issues. So I would say, let's think about your tax position, your residence position going forward, wouldn't I? Because that's my job. But usually I would say, well, actually, it's the personal and commercial objectives which should drive any decision. But I think something like this, once you've made the decision, yeah, actually, I'm going to go and live abroad, start thinking about things such as your tax residence and what it may look like before you actually leave the UK, because just, I guess, packing up a few things in a suitcase and jumping on a plane and arriving, although I guess is quite an exciting thing to do, it may not be the best thing to do from a sort of personal tax and personal wealth standpoint. So fortunately, Jimmy, although he's generally an impulsive character, he's listening into this webinar and is heeding my advice. So he's asked us to think about his tax residence and the various rules which might apply. And now, if we were having this conversation, just over 10 years ago, there was a really ridiculous scenario where there was no statutory test of residence on the UK tax code. It was effectively a piecemeal case law, really, which you had to look at to analyse your own tax residence position. Fortunately, since 2013, we've had something called the statutory residence test, which, as we will get to, and you may appreciate after I've been talking about it for a few minutes, is actually quite complex. But what it does give you is, as I think I mentioned earlier, if you feed in the right information, what comes out should be something which gives you some certainty and something which you can plan on. Now, out of all the permutations and the ways that people could become non-resident, I've decided to really focus it on a particular area, and that's where somebody goes, leaves the UK, sets up abroad, and intends to work there on a full-time basis. And that just enables us to, I guess, stay in a channel rather than going off on some serious cul-de-sac. So, as I say, Jimmy is going to go to the UAE and he's going to work full-time. And if you remember, he had a couple of options, which broadly would be he was going to work as an employee of a third party on a full-time basis. Alternatively, he could be looking at, again, speaking to Paul and the Virtue Zone team and setting up a company of which he is an employee. So essentially, he's an employee of his own company. The same rules would apply in that scenario. So if we look at the general position around UK tax residents, then it's a bit like a light switch, really. So for the entire year, you're either UK resident, switched on, or you're non-UK resident, switched off, and that applies for the full year. Simple, but perhaps could give some unfair results. But if we just deal with that basic position first and foremost, as I say, we need to look at the statutory residency test, which is on the statute book, but also there's quite a lot of helpful guidance in the HMRC manual, with lots of examples in there if anybody is sad enough to want to go and have a look at it themselves. So the statutory residency test, it's a bit of the name is a bit of a is a bit of a sort of double six, really, in the sense that it's much more than one test. So you have three main tests, and they represent basically a waterfall. So what I mean by waterfall, good question. It means that we look at the first test first, obviously, and if we satisfy that test, we stop there. So if we only move on to the second test, we don't satisfy the first, and we only move on to the third if we don't satisfy the second. So, and the first of these tests so step one is basically determining whether any of the automatic non-UK tests apply. So that pretty much does what it says on the tin. If you satisfy one of the numerous tests within that first step, then you're non-resident. You don't look any further. If you don't meet any of those tests, then you look at the second stage, which is whether any of the automatic UK tests apply. And again, the name there is pretty accurate, that if you satisfy any of those tests, then you are UK resident. Clearly not necessarily such good news as the first one. If we don't satisfy any of those tests, we then move into what's called the sufficient ties test. And this tends to be what most people in their minds, when they're determining whether they are UK residents or not, they automatically leap to. And the sufficient ties test basically asks the taxpayer to add up the number of ties they have with the UK. So whether they have family in the UK, whether they have accommodation in the UK, whether they have work in the UK, and one or two others. And the more tests that you tick there, so the more of those ties, sorry, that you tick, the less time you can spend in the UK without being non-resident. So it's really count your ties, and then you're into day counting mode immediately. And that's what most people think as the residency test. What I prefer to do, though, with my clients is make sure they get themselves into that first stage. So if they get to a point where they can satisfy any of those automatic non-UK tests, then we don't have to look at anything else. So is there anything in there that we can hang our hat on? And I think in Jimmy's case, again, if we remember that he's going to the UAE to work for either a third party of his own company, then we can get him very much into that first automatic non-UK test. And that's in a scenario where he works full-time for a year. He spends no more than 90 days in the UK for a particular year. And then he limits his UK work days to 30 days or less. So again, working full-time overseas, doesn't spend any more than 90 days in the UK. And when he is in the UK, he doesn't work for more than 30 days. And a work day is 3 hours or less. So you can come back to the UK, pretend you're working, but say, look, 3 hours, I'm done. Otherwise, I've got another work day.
And
so that's the legislation.
There on that. Is the 90 days in a calendar year or in a tax year?
It's tax year. Yeah, good question. Pretty much everything I will talk about today is by reference to tax years. And as we know, we have and I won't go into the historical backgrounds, but we have the ridiculous scenario where our tax years are the 6th of April to the 5th of April, obviously. So that kind of thinking works pretty well in a scenario where, let's say Jimmy goes to the UAE on the 5th of April, so a day before the new tax year. He knows he's going to be out for the entire tax year. So say he goes on the 5th of April, 2024. He stays out for the entire tax year of 24-25, and he's working full time. He doesn't come back to the UK for more than 90 days, and he's lazy and doesn't do any work whatsoever in the UK. So we know that that works quite nicely if you can manage to get away on the 5th of April or just before the start of the new tax year. But we all know that life isn't that convenient. What if somebody goes halfway through the tax year? That might represent a problem, but we do have something called split year treatment, which will assist in this scenario. And in the context that we're looking at for Jimmy of working full-time overseas, if absent the split year treatment, he would have been resident in the UK for that particular year. He was a UK resident the previous year. And then in the following year, he's going to be non-UK resident based on the fact he's working full-time overseas. So he basically needs to spend a complete tax year outside of the UK. Then split year treatment would apply to him. And again, I keep saying this, split year also does what it says on the tin, in the sense that it allows us that from the moment he goes to work in the UAE, he is non-resident. The time before that in a tax year, he's treated as a UK resident. So in other words, you're slicing and dicing the tax year in two. The part before you go to UAE, you're non-resident. The part afterwards, you are, so it's a part before you're UK resident. The part afterwards, you're non-UK resident in that example. So hopefully that makes some sense. As I said, the statutory residency test is incredibly complex. And whereas what we had previously, so before 2013, when they brought in the statutory residency test, we had a load of case law, and the case law was incredibly old and tended to deal with situations where you might have a wine merchant who was traveling, from the northwest of England down into France. And clearly, when you're putting your wares on the back of a horse and cart and traveling for days to France, the tests required to determine residence are slightly different to the world that we live in now. So it's probably, I think it's fair that the test is very complicated, because it has to deal with all the permutations of what could happen in the modern world. But what it does give us, as I say, generally speaking, a reasonably certain outcome out of the sort of back end, assuming that we can put in the right facts. So that covers off his domicile. So let's say now he has moved. He's finally made the move, feeling confident, well advised, and he's become non-resident for 2025-26. So I think in this scenario, we're going to say that he's non-resident for 25-26. We're not going to look at split year or anything like that anymore. So let's assume that for that year, he's definitely non-resident for the entire year. The offer comes in, the formal offer comes in from that third party, if you remember. He was offered £10 million for his double glazing business. That's come in, let's say, May 2025. He does the deal. Again, he's quick acting. He gets the deal done. So if he's non-resident, for that year, then he's not subject to UK capital gains tax at all at the basic level. So even though the shares are in a UK trading company, capital gains tax in the UK is a pretty simple affair, and if you're non-resident, then generally speaking, you don't pay UK capital gains tax. Now, from 2015 and 2019, there's a big exception, and that's for real estate in the UK. So pretty much any way you hold UK real estate, regardless of whether you're non-resident, you're going to pay UK capital gains tax. But this isn't a property company, it's literally a trading company. So under basic rules, no capital gains tax if he sells in the year of non-residence. However, there's a pretty big trap built into the capital gains tax legislation, and that is called the temporary non-residence rule. So let's look at two parallel universes. In the first, he sells the shares in 2025-26, but returns to the UK within 5 years. So he's not outside of the UK for 5 complete tax years. If that happens, when he returns to the UK, that capital gain will resurrect itself like Lazarus and bite him on the tax bottom. So that's not good. However, if he can nudge his stay out, and in the example on the slide, I think we're looking at around 6 months, he extends his residence in the UAE for another 6 months, then that gain will escape capital gains tax in full. The key is 5 years, and it's a really important thing to remember. That rule only applies to assets you held when you broke your UK residence. So let's say, I think I mentioned Jimmy likes his property too, and let's say he goes down, the DMAC or the Select offices and buys a few off-plan properties over the years, buys them while he's in the UAE, he sells them while he's in the UAE, that will never be subject to UK capital gains tax. There's also an income tax equivalent as well, which works in a similar way. It's a 5-year tail. It's more limited and it's more complex, so we won't talk about this here. But if you're looking at doing, let's say, some fairly proactive dividend planning with UK companies, then it's worth just checking whether any anti-avoidance rules might apply. So I think we're going to look at the tax position in the UAE now. Yeah, okay. So tax in the UAE, what am I on? Now, there isn't any, is there? Well, sadly, that's not quite true. There's no, well, generally speaking, there's no personal tax at all in the UK. So if you're an employee and you're taking your salary home, for instance, there's no tax there. But corporate tax was introduced with effect from June last year. In terms of somebody commenting it who's I guess, grown up in the UK tax system, it was slightly novel that the corporate income tax law came into effect prior to most of the legislation being released. It since has been drip fed, but that was quite a new experience for me. And I think the reason for that primarily was to really remove the UAE from Polanders may have a different view on it, but I think it's to get the UAE off the tax and auto step primarily, and I think it has been successful, as you see around the world, that the UAE comes off various financial grey lists as a result of bringing in.
Yeah, I think it does. I think it does too. And it does it removes us from the grey lists. Also, that not only diversifies the economy away from traditional markets and keeps some money here, but also adds credibility to the country as well. And then people start talking about Dubai and the UAE in the same sentence as Hong Kong and Singapore, and not Panama, for example, in the 90s, right? So yeah, that really adds credibility, and that then attracts further foreign direct investment and regional headquarters of multinationals. Again, further just enhances Dubai's position, solidifies that, and investment.
Absolutely. And of course, we've had for a good few years now VAT in the Gulf states as well. So in terms of as one might expect, corporate income tax is payable on the taxable profits of taxable persons in the UAE. Now that's broadly speaking the accounting profit plus various tax adjustments, which we won't go into today. But the rate of tax, it says on the slide, is 9% there, but there is essentially a 0% threshold as well. So the first 375,000 dirhams, which I think is about 80 grand when it comes to sterling, and just over 100,000 US dollars of taxable profits, then that's at 0%. The excess taxed at 9%. There's also, and something that I've been discussing with Paul's colleagues last couple of days, is small business relief, which is a relief, that's my guess, which applies to slightly smaller businesses, and small being defined as no more than 3 million AED. So where your revenue figure is
It's a pretty big amount, Andy, right?
Yeah, absolutely.
Almost $1 million, and we're calling that, the small business relief. So it just shows right now, small businesses are certainly not the target market for the tax authorities here. It's certainly larger.
Yeah, and a lot of the international sort of, I guess, action on tax. If you look at the OECD work and sort of the BEPS program, and a lot of talk of sort of Pillar 1 and Pillar 2. What we often forget is most of that is aimed fairly and squarely at large MNCs or MNEs. I think people started calling them now, so multinational enterprises. And if you look at the turnover profit figures they apply to, they're astronomical actually, and most businesses aren't going to be affected by a lot of these changes. The small business relief is attractive because the effect is that the taxable person, and you have to elect for it, but if you elect for it, then the taxable person is essentially treated as having no income, no taxable income in the year. So the rate is essentially 0% there. So yeah, not too shabby at all. There's slightly different rules as well for qualifying free zone persons which have qualifying income. But again, we can discuss those if that is applicable at some other time. So what we're looking at now, so we've got Jimmy here. He's sat in the UAE. He's nothing really drawing him back to the UK, but he's been down the paddle club, and he's been talking to some of his mates, and there's this concept of inheritance tax is being discussed. So the current position under UK law for inheritance tax is fairly clear, but it does cause a lot of confusion for expats. Jimmy's position, well, let's start with a UK domicile person. So somebody who's UK domicile but has come to live over here in the UAE. Now, it comes as a huge surprise time and time again when I speak to expats that they may have been living over here a number of years, but they still have an exposure to UK inheritance tax on their worldwide assets. And that's a big shock to them. Now, if they've been here for a much longer period of time, so you're looking to maybe them being here 10 years or more, you might look to think about whether it's possible for them to acquire a domicile of choice in the UAE. So effectively, that they are non-domiciled from an IHT perspective. And that is quite possible if you can demonstrate and provide some kind of evidential basis that you have made the UAE or alternative place, and if you've moved somewhere else, your indefinite home. Now, there's a slight wrinkle from a UAE perspective in that it's not possible to get permanent residency here. So Paul mentioned the golden visa, which gives you the right to stay for 10 years. It isn't possible to get a visa which allows you to stay here indefinitely, and that does raise a few questions about, well, if you're only staying here as long as the government allows you to, can you ever say you have developed or sorry, acquired a domicile of choice in the UAE? Now, there's very little case law on this, and the case law that does exist is not terribly helpful. But that is a particularly egregious case, and it was a fraud case, to be fair. But I don't think it's necessarily terminal. I think in a scenario where you have somebody who maybe has had a golden visa and is renewing and successfully gets a second golden visa, I think there's an argument there that the person maybe has potentially acquired a domicile of choice in the UAE. As Jimmy is non-domiciled, however, he will only have a UK inheritance tax exposure under current rules on his UK asset. So his position is slightly different. And this is a thing, inheritance tax at the moment is almost purely determined on your domicile status. So that takes us into what is going to happen now the government has made clear it wants to dig a hole and bury domicile as a UK tax concept. Well, we are told, we've got much less information on this, but we are told that they are going to change the triggers for engaging UK inheritance tax, and it will become a residence-based test. So the earliest that could be is the 6th of April 2025. I suspect it may be a year or two after they remove it for income and capital gains. But if you imagine a scenario, let's say it looks pretty similar in concept to what they're doing for foreign, when they're looking at replacing domicile with a residence test for income and gains, and saying, well, if you've not been here for 10 years, you've not been UK resident for 10 years, then you're in a special club. I can see a scenario where if you haven't been resident in the UK, say for 10 years, that you only will pay UK inheritance tax on UK assets. I still can't see a scenario where the UK will give up its death duties on UK assets, but if you've been non-resident for 10 years, then you won't have an inheritance tax exposure, potentially. And that will be something that I imagine lots and lots of expats will be paying some attention to. Well, the ones that are actually aware they've got a problem in the first place. Many may be on what I've seen over the last few years, maybe blissfully unaware. But for those that understand the position, I think actually there might be an area of interest going forward for the next
and is it
years.
still
watch this space.
£375, Andy?
So the nil rate band is 325,000 yet.
Did it used to be 75? No, I thought it was 375.
I think it has been. It's been at 325,000 for a long time. I think it has been higher in the past. I can't remember, but it's been at 325 for well over 10 years.
And is that in combined assets?
So if you're married, then you can transfer your nil rate band. So let's say you're married and you've decided that you're going to transfer all the assets to the surviving spouse on first death. So the surviving spouse ends up with everything on survive when they survive. They can also get the benefit of that first no wake band as well. So on second death, you essentially get £650,000 no wake band. There is also a special nil rate band around the residence, the main residence, but that tends only really to be useful for people who aren't particularly wealthy, but most of what they do have is locked up in their main residence. So let's say you've got somebody who earns fairly ordinary sums, they've got fairly ordinary savings, but by quirk of fate, maybe they invested in the London property market in the 1980s. So they're sat on a property which may be worth a normal sort of family home that's maybe worth £2 million. They've got not much else at all. Then there is a special nil rate band which can cover an extra, essentially put the combined nil rate bands up to about £1 million. But once your total estate gets above, I think, about 2.5 million, you lose it completely because they don't want to give it to people who are of serious wealth, I guess.
And then,
so I think that's kind of me finished. So Jimmy, we've sold Jimmy's IHT position. Is happy as Larry.
Okay, well, look, we're coming up to 6 o'clock, pretty much almost 6 o'clock. We have a couple of questions that we can have a look at, and Andy, I don't know if you can see the questions. It's only me that can see them.
Yeah, if I could click on it, I can. My mouse has just run out of battery at the.
Yeah, that's fine. That's fine. But what I'll do,
let me use my finger. There we go.
I'll jump in with a couple of them now. The first one we've covered, right? When you asked if I could tell you the difference between mainland and freezer in the UAE, we already covered that. Next one was from Manib, which says, if I have a golden visa in the UAE, do I still need to register a mainland company to do business? Or is there anything similar to self-employment? Yeah, there's yeah, look, if you wanted to, the visa allows you to live here and gives you the ability to work here, so to be in the country legally. To conduct commercial activity and to invoice, yes, you would need a company. Doesn't need to be mainland, it could be free zone as well. You asked if there's anything like self-employment. There is freelancing, but it's not really great. It's not like being a sole trader in the UK. So if you're a freelancer and you have a freelance visa, let's say you're a photographer, it allows you to act as a photographer. For example, you could go and work inside a business and do photography inside that business for them and be paid by them. But I can't ask you to come and photograph my wedding, right? Or do a photo shoot with the kids. So you can't trade with the general public, but you can be employed short term by a company as a freelancer to do work for them. So there isn't anything too similar in that regard. There's a question from Mo. I'll just read it. I think it might be for you, Andy. It says, are there any specific tax considerations related to my employment status, such as if I'm moving to work or starting a business in the UAE?
Okay, yeah, I'm not entirely sure where that question is going, but if you're moving to the UAE to work or start your own business and work for that business, well, I'm sure we all understand that a company has its own legal identity and it can employ you. Under that scenario, my view is it's very easy, or certainly very clear, how you become non-resident and how the split year treatment applies. And split year treatment is really useful because I use the example of myself. I moved on the 17th of September 2023. As long as I remain non-UK resident for 2024-25 and don't take up residency again until after the 6th of April 2025, I know my entire period living in the UAE, I'm non-resident from the moment I go to the moment I come back. And just being very clear of that is important because, broadly speaking, anything that you earn from outside the UK in a period of UK residence is probably going to be taxable, but anything you earn from overseas in a period of non-residence isn't going to be taxable in the UK. So that's quite an important foundation, a building block. Understand where you stand as early as possible from a tax residence point of view. Hopefully that answers the question.
Thank you. And another quick one, Andy, is can you stay for 90 days at a time, or does that break the working abroad test?
Well, so it's an interesting one. So the working, sorry, so one of the things that, in order to satisfy the requirement of full-time working abroad test, is that you the 90-day, so you can't spend more than 90 days in the UK. But even where you satisfy that requirement, so let's say you spend 75 days in the UK, you give yourself a real nice bit of headroom, nice and safety conscious. But if you spend 60 of those 75 days working in the UK, then you won't satisfy the test. Now, it's not that it's not that draconian, degrees of draconianness, because it's not literally as soon as you flip the laptop open, you've done a work day. You get 3 days of 3 hours of looking through your laptop and doing a bit of work before it constitutes a work day. So what I do when I go back to the UK, I just make sure that I never ever work more than 3 hours a day. Because I'm quite lazy. But when I go back to the UK, I just think, well, I'm not here to work. Might answer an email or two, might take a call or a meeting, but just be disciplined. Don't go out of your way to generate a load of business.
And then just to wrap up, Kevin asked if we can get a recording of this passed on. Yes, absolutely. We'll share that with you. And there are, again, we have to wrap up now. There are a few other questions. What we will do, we'll type answers to them and get back to you after we're done here. Okay?
Yeah, I'm assuming if we've got people's emails, I'm happy to give them a quick short answer, because there are still some interesting questions left, aren't there? So I'd be ashamed to leave people hanging.
Yes, we'll do that. You can, if you want, Andy, the questions that are aimed at you, you can type answers to them and send them back right now. All right. And at that point, we will we'll end the webinar here. And thank you very much for joining. But we have the email addresses of everyone who registered. We have the questions, and myself and Andy will reply to the questions. We'll share them between us. We'll reply to the questions between tonight and tomorrow. Okay. Thank you very much. Thanks, Andy, for.
Thanks, guys. Thanks, Paul.